All right, today we're going to pull back the curtain on one of the most common numbers in all of finance. We're going to talk about a secret, a flaw, really, that's hiding in plain sight. And honestly, once you see it, it can completely change how you look at a company's value.
But first, let me ask you something. If you get a job offer and it's for 100 grand a year, is that how much money you actually get? No way, right? Of course not. After taxes, healthcare, all that stuff, your take-home pay is a totally different number. Well, that same exact idea applies to valuing companies.
So when investors want that quick and dirty snapshot of a company's value, what's the first thing they look at? Well, almost always, they turn to the market's favorite shortcut.
And that shortcut is the price-to-earnings ratio, or PE. You've seen it everywhere. It's simple, it's fast, and it seems to answer the big question: is this stock cheap or expensive? It's the go-to metric. But just like that big salary offer, it's only the start of the story.
And this is the main idea for today. So really let this sink in. The PE ratio is the gross salary of a company. It's that big, flashy number that everyone quotes. But it is not the cash you can actually put in your pocket.
And that's exactly where the problem is. Relying on that big number feels easy, but it can be, well, a flattering lie.
You see, the earnings part of PE comes from standard accounting rules. And look, those rules are fine, but they can paint a picture that's a little too rosy. They don't always show the real cash that a business is actually generating day in and day out. And the biggest reason for that difference is something called capital expenditures, or CapEx for short. This is real cash a company has to spend to stay in business. Buying new machinery, upgrading their buildings, keeping their tech up to date. It's not optional. It's the cost of admission.
And here it is. Here's the fatal flaw. The standard earnings number doesn't really factor in all the cash a company must spend just to keep the lights on and stay competitive. PE kind of just glosses over this huge hidden cost.
Okay, so if the most popular tool is broken, what's the fix? Well, thankfully, one of the greatest investors ever pretty much gave us the answer.
Warren Buffett talked about this idea he called owner earnings, and his philosophy was dead simple. Forget the fuzzy accounting profit. He wanted to know how much real cash could an owner pull out of the business at the end of the year without hurting it.
And that's what owner earnings is. It's the true, honest-to-goodness cash profit. It's the money that's left over after a company pays all its bills and reinvests what it needs to stay in the game.
And this brings us right back to our analogy. If the PE ratio is your gross salary, then owner earnings, that's your take-home pay. It's the number that actually hits your bank account. It's what really matters.
Now you might be thinking, okay, this sounds complicated. But the beautiful thing about owner earnings is that the logic behind it is super straightforward. Let's just quickly break down how you figure it out.
It's really just 3 simple steps. First, you start with that reported profit everyone else uses. Second, you add back things that aren't actual cash expenses, like depreciation. And then, the most important step, you subtract the real cash the company spent just to maintain itself. What you're left with is a much, much more honest picture of profit.
So, does this actually make a difference in the real world?
Oh yeah. This is where it gets fun.
Let's look at a tale of 2 companies.
Okay, check this out. At first glance, Company A and Company B look like twins. Same share price, same earnings per share, which means they have the exact same PE ratio of 10. A typical investor might just stop there and say they're the same. But now, look deeper. Company A only has to spend $1 per share to maintain its business. Company B, it has to spend a whopping $7. That changes everything. Because when we calculate their real owner earnings, Company A is generating $9 in cash, but Company B is only left with $3. All of a sudden, they don't look so similar anymore, do they? So here's the punchline. Based on that simple PE ratio, both companies look like a pretty good deal. But when you look at the price compared to their real cash earnings, the truth comes out. Company A is still a solid value, but Company B, wow, it's trading at over 33 times its actual cash flow. What looked like a bargain is actually crazy expensive, and the PE ratio completely missed it. And that, right there, is the power of this idea. It's all about pushing past those simple surface-level numbers to get a much clearer, more honest view of what's really going on. So, what's the big secret? It's that the PE ratio, as popular as it is, can hide as much as it reveals. Owner earnings cuts through the noise and shows you a company's true cash-generating power. It leads to a smart evaluation, and maybe most important of all, it helps you see the opportunities and the traps that everyone else might be missing.
It really makes you stop and think, right? Just like a salary isn't just one number, a company's value isn't just one simple ratio. Which kind of leaves us with one last question to chew on. What else in our world looks simple on the surface, but is hiding a much more complex and fascinating story right underneath? Thanks for tuning in.